Alrighty, as stated, now we're going to go into our cash. Um, and notice what they're saying, what they're doing here is when we're doing the cash, as far as we're the ones that are buying stuff, we now have to issue out the checks. So here we're going to be seeing the checks that we're issuing out, of course, to these other companies, and how much we're going to be doing, and how much is going to be based on, like I said, less the return and a 1% discount. Okay, so if we look a little bit closer, let me go ahead and bring this up a little bit. You see it. So if we go ahead and look at this, here we go. We have cash as an asset, of course. It's a credit, it's a rule. Our purchases is a contra cost, okay, as far as how much it actually costs us on the purchases discount. And then, of course, the accounts payable is our liability, okay? So here we're showing where the April 12th transaction took place. We went ahead and we bought so much from the Thorpe Company, but we got a purchasing discount. So notice we're going to still show that we're paying out the entire account, okay? Because they're giving us a discount. So they're telling us, hey, you don't have to pay the whole thing, because as long as you pay it within 10 days. They'd rather get most of their money, mostly all of their money, than not anything at all. So it's an incentive that they use. So here we're saying we're going to credit the accounts payable for Thorpe for the entire amount. Then we're going to go ahead and credit the $6, okay, on the amount. And it's not 10%, so it's not $60. It's a 1%, so it's $6. So we now going to go ahead and pay him the $594, and then we go ahead and show which invoice we paid out, and it should be also noted on the check that we're paying out, okay? So that's how we journalize April 12th transaction. To complete a set of payments, a set of cash payments for the journalized transaction for the month, this is what we would show. Now, we're showing that we are doing the prepaid insurance. We're paying it in advance. Here we're showing where we're paying out the entire $4,000, no discount whatsoever. We're showing that we now purchased some stuff, right? So we're showing a cash purchase. We're also showing again where we got that we're paying out the invoice for the Thorpe Company. And now here we're showing also a salary expense, that we paid salaries. And all of these are going to be dealt with their specific accounts. These two, of course, are going to be with their subsidiary accounts as well. The account payable, the controlling account, and the subsidiary. And then, of course, our regular accounts, all the stuff that we have to pay out for cash. Okay? This is what it would look like if we were doing the T accounts. Okay? Again, zero balance because we paid everything out. Okay? Now remember, when we pay it out here, always remember that we must show it also in the controlling account for accounts payable, just the way we did with the accounts receivables as well, right? When we do a partial set of cash payments for the month, okay, what we do then there is, let me bring this back down so you can see it, sorry. What we're doing then, of course, is we're showing just that one portion of what we did. But we're still showing it again in the accounts payable controlling, and then again for each one here, for each of the subsidiary accounts payable. Just as we did a schedule of the accounts receivable, there is a form or a financial statement for the schedule of accounts payable. This is proof that the sum of the accounts payable in the subsidiary ledger is equal to the controlling account. You must equal. Only creditors owed, only the ones that we owe are supposed to be there. Okay? Then if it doesn't balance, then of course we go back and check. This is a way of making sure that we're checking, and we know how much the balances that we owe are going forward into the next month. And just like and we do it at the end of the month, just like the accounts receivable, this is the accounts payable, who we still owe the amount, and this should be the amount that is in our accounts payable controlling account as well. Now, here we're also dealing with the merchandise and or the inventory that we purchased, okay? We have to make sure that we know how much inventory comes from the suppliers and then how much is being sold out. Like when we go to Walmart, the little blue, 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 blue. Okay, that's now a software that not only goes ahead and shows us how much is going out, it keeps track of our inventory. Yes, they do a physical inventory as well, but they takes care of their inventory. So at a certain amount, like for example, they say, okay, we've sold so much of this, we need some more. So they decide when they get to this level, order again, and not until then, because we know how much is going to be coming in. We know when it's going to come in, so that we always have, again, a perpetual amount of inventory, plus we have to keep track of the inventory. If something's not selling well, then that's where we give the sales discounts. And we say, okay, let's move it out, let's get rid of it as soon as possible. Better to get some money from what we've purchased than no money at all, because we still have to pay the vendors that sold it to us, okay? So again, we have the cost of the goods or the merchandise that we're selling. That is the total cost of the merchandise, of the inventory that's brought into the store and sold, okay? So we're now dealing with what is our gross profit. So before operating expenses. So that would be your sales revenue. Now remember, we know how much we have made, right? Our gross income, and then we know our net income after all our expenses are paid. But this is just finding out how much money we made on, let's say, sales, and not just on consulting or anything else. This is just on this. So you have your sales revenue, then you minus the cost of goods sold, and you should see how much your gross profit is on sales. How much, and the reason that we're doing that is because we want to see, if we're buying other things, we want to see how much is of our money is coming from what we're selling. Now, in other areas like Walmart, they're not only breaking it down from just total sales, they break down that sales even more. How much from groceries, how much from dry goods, how much from clothing, how much from home and decor, how much from the craft section, how much from the automotive area, the sporting goods, how much from just the automotive area that does the service of oil changes and stuff like that, from the eye center, from the beauty salon that they have that there. Yes, I know Walmart. I know most of the stuff that they sell, okay? So again, they've got it all sent out. You'd have a total of your sales, but then you break it down if you've got a lot of things that you're selling. You want to know how much money and where the money is coming from, what is selling, what is selling well. And remember, the reason that we're doing this is because, again, we're analyzing what is making the money, and you want to keep selling the goods that are going to be selling the money, okay? So with net income and net loss, again, what I was talking about, here we go. We have Walmart sales and revenue right here, okay? Cash and accounts receivable, what people still owe us. Cost of the goods sold, which is the cash, accounts receivable, plus how much money do we have in inventory, okay? Gross profit is going to be the profit before any expenses. Then we look at the operating expenses. Expenses not directly related to the sales, like salaries, okay? Like utilities, okay? Things like that. Then you get your net income or net loss or your gross profit less operating expenses, okay? That's what we do. That's how we're doing it for a merchandise company. And we're going to be seeing that as we do the demonstration, okay? So when we're looking at this, what we're doing is we're matching the revenues and the costs. So if we sold something, the sale of the TV was $500, then how much did it cost us? It cost us $300. We sold it for $500, so the profit was $200. Okay. Now remember what I told you guys before. Anything that we're selling above 0.33% is a profit. Of course, they're going to sell it for a lot more. Okay. The other thing that it helps us to do is to make sure that we've got a inventory, that we're taking care of it, so that if something is stolen, then we know immediately, wait a minute, I had 9 of these, now only showing 7, and I haven't sold any. Where are they? Are they on display? What's happening? When we're recording the transactions from the buyer's position, which is the one we are right now, we're buying things, okay? Our inventory account is increased when merchandise comes in, and then each order is documented, and we bring the cost in. This is the cost of bringing the merchandise into the store. It's not the price that we're going to be selling to the customers. It's our cost. Okay? So we have the merchandise inventory and our accounts payable. So this is the amount of inventory that we brought in from Sony. So this is how much our accounts payable is, how much we're going to work with. Okay? Now notice they're flat screens. Terms are 2% if we pay in 10 days, or N if we pay in 30. That N means this, okay, if you were wondering. Sometimes they'll give you another percentage, okay? Let's say they only give you 1% if you pay at 30 days. But either way, you've got to pay out. And sometimes it's at the end of the month that you've got to pay out. It's clearly stated on the invoice. But that's what usually the terms are. Either 2% or whatever the percentage is in 10 days, and then if they decide to give you a percent in 30 days, okay? Now, when we're recording the merchandise or transactions from the buyers, again, not all purchases will go into the merchandising inventory. That means supplies and equipment that we are going to use that are not for resale, okay? And they're debited to the specific account, like supplies, like equipment. So when we're doing this from, again, shelving equipment, okay, we pay more for it, okay, but it's shelving. So it's something that we're going to put our stuff on. So it's not really direct, going to go ahead and be put in. It's just equipment on account, okay? When we're recording purchases and returns and allowances, remember, if there was stuff that we're sending back because it was defective, then we debit Sony, decreasing the amount that we owe them, and also we must decrease the merchandise inventory as well, okay? When we're recording the purchasing discounts, again, notice what we're doing here. Walmart pays Sony within the first 10 days. So it was $7,000, but it's minus the $600 of return, okay? So this is our accounts payable, $600 from what we owe them, not from the $7,000, but from what we owe them right now. We now owe them only the $6,272. So the amount that we're going to end up bringing back out is to show also that we paid them out in cash, and that we are crediting the amount of money that we're going to get as far as a discount, okay? on merchandising inventory. That's all we're doing. Don't worry, like I said, it's going to be clearer as we do each of the transactions on the homework demo. Okay? So we're recording the cost of freight. Okay? Again, merchandise inventory, cash, when we're paying it. Okay? Recording the transactions from the seller's position. Again, if we're the ones doing the selling, then we're recording the earned revenue at cost. We're recording the allowances as well, sales and returns allowances. This is when we're remember, now we're the ones selling the stuff. When the returns come in, seeing the other point of view, which we did last week as well. Okay? And then the sales, returns, allowances. Again, remember, we did this last week as well, showing what we're going to do, reducing the amount that we've got when we are now the ones that are selling and we're taking back the goods. So what ends up happening is this. If we have stuff that is returned to us, very simple. We first get the merchandise. We sell it. Customer comes back and they say, hey, this is defective. We issue the credit to the customer. Then we go back to Walmart, to the vendor, to say, hey, this is defective. So we're going to show what's defective, decrease our inventory because we're not going to keep it. We're still going to send it out to show, hey, this was defective as well. Now, those are coming in individual transactions. However, they're all, at the end of the day, each transaction that comes in, have you ever gone, excuse me, I know I'm pausing here, but have you ever gone to return something to Walmart in a day? How many things that they get returned as well? Every single one, because you can't lump the inventory, even though at the end the total inventory will be there. You still have to show where the return was from. Was it from groceries? Was it from housewares? Was it from clothing? Then where in clothing? Was it men's? What was it women's? Was it boys? Was it juniors? Was it babies? Where was it? Making sure that you're reducing the correct portion of inventory in order to go ahead and have your book straight. Okay? Again, the recording of sales discounts when we provide the sales discounts. We did this last week. Should not forget what we did. Actually, it wasn't last week. It was chapter 9. Yes, chapter 9. This is now chapter 10. So we remember this, okay? So again, we show everything that has been done, how we are the buyer and how we are the seller. Walmart the buyer, Walmart the seller, showing both sides of the coin because they are buyers as well as sellers. So they're going to have the cost of inventory going out, selling, and then the cost of inventory coming back in because it's defective and then sending it out to somebody else, whoever they purchased it from, and them getting their funds returned or recording the fact that they're not going to pay out on all that inventory because it was defective and I'm sending it back to you. So that's what we have for this week. What I'll be doing now is I'll go ahead and I'll also provide you the demonstration so that you can see what one of the homeworks looks like. Okay? I'll see you on the flip side.